Peter Rose, Longwood Currency Trading. It's mid-October now. We're getting on with our fall season. As I have shown you, some of the one of my previous videos was leaves changing colors and price action changing with it. And this video, what I wanted to do is talk about how to manage Forex positions under volatile price action conditions. Now, I did another video recently on Forex good volatility versus bad volatility. And that video talked about more of the what. What is good volatility? What is what is bad volatility? In this video, I kind of want to take the next part of that. Not only do you need to know what something is, but you need to know how to use it, how to manipulate it to your advantage or to your good. And so I sort of hinted at that in the previous video when I talked about, which is one of the two reasons I'm going to talk to you about, or one of the two methods of how to manage volatile positions. But in the first one, I talked about combining that volatility with a direction of that price movement, which was a momentum, an indication of momentum, because a momentum has a velocity vector, right? In physics, it's mass times velocity is momentum, and velocity has a magnitude, how big that velocity is, and it also has a direction. And so if you combine the volatility of price action and it is in an upward direction, for example, then you'd probably have a good probability, you'd have a good probability that if you went long at that point, that you'd probably work out fine. Now, that's one way as to how to deal with it. Now, I didn't really fill in all the blanks on that, but we did talk about measuring the candle size, which is an indication of momentum. You know, you can have price volatility, you can have small bodies and big wicks and long tails. I mean, that indicates a very volatile situation when you have a half a dozen or so of those candles. That you have a very volatile price action, but it doesn't necessarily indicate that there's any momentum to it. The change in momentum is indicated by a change in the size of the candle body moving in one particular direction. You have to have both aspects in order to bring momentum into it. And so in seeing a situation where you have volatile price action, but it's all moving in an upward direction, you have, if you're down in the short-term time frames, you've got 5-minute candles. In my particular currency pair that I've studied for a long time has an ATR average out of about 5 pips. And so if I start seeing volatile candles that are 10 or 12 pips and they're all moving up, kind of like sequentially, then I've got to say not only do I have volatile price action, but I also have direction to that volatility, and so therefore I'm going to be able to get in and trade that. You have to watch out that you're not catching the top end of that volatility. So if you're down on a 5-minute time frame, you might have 3 or 4 candles, 5 candles, you know, that's giving you that emphasis. And if that keeps up, you might want to hop up to the higher time frame of 15-minute and see that those 3 or 4 5-minute candles is one 15-minute bar, and how that 15-minute bar is in relationship to the other one. Do you have that directional bias to that volatility or not? And so you can evaluate then whether there's valid momentum in that particular series of candles to carry it forward or not. So that's the first way of managing a position during volatile price action conditions. I would have to say that that's more, rather than falling under position management, that particular aspect is only valid for price entry analysis. because you're not going to be in the middle of a trade in all this volatility and all of a sudden you get direction to it, because you can't. I showed in the last video that you really can't trade that because you're just going to get chopped, right? So you're going to have a little patience here in waiting to use that momentum part of it in order for it not to be in a volatile condition, and that it presents a part of your trade entry analysis says, well, I'm coming out of this volatility situation. I've got the proper profit target if this thing would go in that direction. And oops, by the way, it not only is going in that direction, but it has a, in other words, it has the magnitude. The candle is indicating that it's moving rapidly in that direction. But also it is moving in that direction, right? So, and there's no, if you're talking about going up, there's no wicks that are being there. You might have a tail on that candle as it starts to stabilize and then pick up that momentum to go in that direction. But you're certainly not going to have a body with a wick and a tail on it. That's just chop. And so you're not going to enter on that, right? So that first condition is really trade entry analysis. The real how of managing the position rests on simply going to a higher time frame. So if I'm down on a, well, let's say I'm on a 15-minute time frame, and the price is just chopping around all over the place, and I just go, man, I don't know what to expect. I'm going to have to wait till it, till it settles down or it breaks out. I don't know when to trade this thing. So you go up to a higher time frame. Well, first of all, that volatility is happening in a channel, a zone, right? So you're in a 15-minute zone, normal 15-minute candle. Let's say it has an ATR of 10. So let's say you're banging around back and forth between a 40 pip range, that these 15-minute candles are just bang, 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 going back and forth over 40 pips. So now you go out to the higher time frame. And I think what you'll see is, I'll throw this picture up that I drew for somebody the other day who had asked me to describe this. You can see that on the top figure, I'm on a 15-minute time frame, and you can see all the chop that's involved. But then you go down to the second part of that diagram, and you can see that I've gone up to the 4-hour. And that chop that fills up my screen on a 15-minute chart only fills up a small portion of the 4-hour chart. And look, the 4-hour chart was way higher than where the current chop is. It's come down, and now it's going back up, and now it's going into this chop channel of price volatility over 3 or 4 times the ATR of that particular normal 15-minute candle. And so what that tells you is that the price has come down from that 4-hour time frame. Maybe there was a big sell-off. Orders were fulfilled. They crashed the price down. Now they're bringing it back up again to take another run at it. But let's go into a chop and get rid of the inventory there before we do what? Before we continue the trend of this 4-hour chart. I mean, I'm only showing the one peak to the left and nothing more to the right of that. But if you really looked at a full 4-hour chart and you saw that this was just, for example, maybe there was a blow-off of price action that took it way up, and now it's come back down, and it's gone back up, and it's come back down, and now this is where we're catching it, so that it's on the way back up, and the long-term trend on the 4-hour chart is upward, and you're involved in a 15-minute time frame chop situation that's bracketed out over the last day or something like that, a week. Nah, probably not a week, but a day or 2 days. I mean, it's not uncommon to have the institutional traders chopping this stuff up to break everybody up and create indecision. And so as the price goes down, they pick up more orders as people get out. And so how do you look at that situation? How would you trade that? There's 2 ways you could trade that. When they chop or price hits the bottom of that congestion area, you go in and buy. Now, what's your risk? Well, the risk is that it could break down below that and stop you out. So you're going to have kind of a short stop there, because a breakout from one of these channels is going to be dramatic, right? You know that. You've seen this stuff happen before. So you could go in at that lower boundary and take a winger at it. I wouldn't dump your whole line on at that particular point, but you could take on, like if you had was trading a $50,000 account and you had 5 full lots, or maybe you're trading 5 minis, I don't know. So at the bottom of the thing, you go in for a mini lot, all right? And the thing goes down against you and it bounces you out, boom, okay, you're gone. You lose 8 pips or 10 pips or whatever you set your stop at, short stop. But it goes back into that channel. Well, you know, from a trade entry standpoint, you made it one time, make it another time. So you go in with your 1 mini lot. And it continues and it goes up. So about halfway up, 10 pips up, you take another mini lot. About 15 pips up, you take another mini lot. Or 20 pips up, you take another mini lot. Remember, we're dealing with a 30 or 40 pip channel here. So you got 3 minis and you're riding the thing on the way up. If it comes back down against you, your average is down where probably the second mini was that you threw in. And so you could exit at that point for a no-risk trade. If it continues to go back up, that's a new trade entry. So you're staggering in your trades. You can only do this if you're trading full mini lots or full lots positions. So if you've got $5,000, you can trade 5 minis. If you've got $50,000, you can trade 5 fulls. But you don't want to trade 5.5 fulls or 3.5 fulls, right? You don't want to trade a mini and a half. You don't want to trade micros anyway. So you only can do this if your bank account is big enough to support multiple lot trading. If it isn't big enough to support multiple lot trading, where you can stage in those lots as you're going up and down in that channel, well, you know, you either take a big gas and you go in with your full load at that bottom support zone line, boundary condition, or you get that wouldn't be advisable if you got to drop your full load in there. So you'd wait until it goes past and it breaks through that top resistance point. And you'd be probabilistically safe as a good entry because you've got the 4-hour chart that's giving you that longer term trend on that. And so it's a good entry point for you, okay? So how do you that's a position that you're managing then. Yes, it has to do with entry, but in this case, you're looking at the overall situation of a position as opposed to an entry. You're not looking at it in terms of, well, where's the best place to get in? You're looking at it as, if I had a current position, would I add to this position? If I had a current position on and it broke this line, would I add to that position? So you're really, even though you don't have a trade on, you really have a mental position. Just like you can have a mental stop, you can have a mental position. You know, look, if you're sitting in front of the screen, you're trading. You're not just sitting there eating your Twinkie and sipping your coffee. I mean, you know, you got work to do. And so this is one of the more difficult non-position holding analysis, not steps, but times that you're going to find yourself in is the decision. And, you know, if you don't have a series of rules developed for these particular kinds of conditions, then you're best to just sit on the side until you get a trade entry situation or a trade entry condition where your rules match up with that. You don't try to match a situation up to your rules. The rules stand heavy. And you look at that, it either matches the rule or it doesn't match the rule. So you got to make your life simple, okay? So how to manage a Forex position, the how part of it, one of two ways. One, you take a look at the momentum component of that. If the momentum is there, then you can trade that volatility. The second methodology is to look at a higher time frame and see what the field of battle looks like so that you can develop some sort of a probabilistic estimate as to what you think the probability is that the price will continue in the direction of the trend of that 4-hour time frame. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.